Welcome, everyone. As always, we are streaming across spaces on YouTube and on Twitter broadcast. Today, we're going to be talking to the founder and about the Gravita protocol. Gravita is a decentralized borrowing protocol built on Ethereum, offering users interest-free loans secured by liquid staking tokens and a stability pool. The protocol issues loans in the form of GRAI tokens and incorporates a mechanism to mitigate volatility. I personally see Gravita as kind of like a pretty thoughtful innovator in the crypto world. They're kind of bringing some new ideas to sort of push the envelope a bit. So with that, we will be talking to Rhett. We've had Rhett on the show before, and he's back. And Rhett's the mind behind Gravita. Before launching Gravita, Rhett was a he was a DeFi specialist at Wave Financial. I don't know if you were senior, I just said that. And previous to the blockchain space, he had a career in machine learning. We also have Netrim joining us, and Netrim is kind of just resident crypto person who's kind of just everywhere. Probably now Rhett or Netrim. He's an active participant in Gravita and also on DeFi Insider, and he contributes to Vendor and Beethoven X. So we're going to get into it, and welcome Rhett and welcome Netrim.
Welcome, guys. Glad to be here.
Thank you. Thank you.
So let's start maybe by defining the problem that Gravita is trying to solve. So I know it didn't just come together with an ambition to just start a crypto project. I know, Rhett, you had like a very specific problem in mind that you wanted to solve. So maybe we can begin with that.
Yeah, I'll give you a little history there, and I would say there's a couple of problems that we're trying to solve. And funny enough, as a lot of people here know, I'm a big fan of Liquidity. Initially, I kind of outlined what I thought needed to be built, and I just went to the Liquidity team and said, "Hey, you guys want to build this?" And they were like, "No, we're building other things." So we moved forward building this. So there's really two really important things that we're trying to solve for. One is we want to give really good utility and DeFi support to high quality liquid staking tokens. And what we found with Ethereum liquid staking is that especially high quality LSTs over the last year or so have been really de-risked in a lot of ways. The merge was a big de-risking event. Withdrawals was a huge de-risking event as well. But we found that a lot of them don't have great support in DeFi. A few do, most don't. And so we want to support both the big and the small high quality LSTs. And we just think that will help decentralize Ethereum. It'll help just bring utility to people participating in a really important part of ETH. So that's piece number one. And then the other thing, in the space, what I call the CDP space, or I guess that's what a lot of us call it, this protocol to peer lending that MakerDAO pioneered. What we kind of think is that the more censorship resistant side of that is just a little bit underserved. I think it's fine to have, both sides of the market served. Like, I like MakerDAO. I think they're great. That was like the first protocol I ever got super excited about, clear back when they were starting to talk about it in, 2017 or whenever that was before they went live. But, you have kind of two, kind of very distinct parts of the CDP market. You have the very scalable, but less censorship resistant stables like DAI that has a lot of USDC under the hood. It's a really great system, but it's very scalable, not super censorship resistant. And then you have these more censorable stables like LUSD and RAI. They do have some scalability challenges because both are single collateral. And we just feel like that side of the market needs to be better served. And so there's kind of two ways that we're trying to help serve that market. One, we're a friendly fork of Liquidity. So we began with the Liquidity code base, and we've made a number of changes, and happy to get into any of those. But we're we're trying to be friendly to them, so that helps serve that part of the market. And then the other thing is we have a strict commitment to keep out the censorable stables. So we're going to be a little bit more scalable than Liquidity because we're multi-collateral, but we won't have the exposure to USDC, USDT, etc. And again, nothing against those who have that. It's just this side of the market is just really, really underserved, we think. If you look at like the top 20 stable coins, probably only LUSD, would you say is like pretty censorship resistant? And so, you know, there's variability, right? So DAI can't be directly censored, but USDC can, and that makes up a lot of DAI. So that piece of the of our mission is really important to us as well. So it's kind of dual purpose, like really help empower LST holders and Ethereum stakers in general is part one, and then the other part is serve the more censorship resistant side of the CDP space.
Netrim, would you like to add anything to that, or maybe tell us why you were interested in collaborating on this project?
Yeah, for sure. Thank you, JF. So basically, let's think about stables. So stables are a medium of exchange. And right now, the crypto space, the Web3 space, is completely dominated by decentralized stables. And as you were saying, there is an underlying risk on those. There is a risk that it goes through a centralized authority. It may or may not have a blacklisting feature, like we know, for instance, USDC and USDT have. And also, the idea of the space, how it grows, it's not going to grow through volatile assets. The people mentality, it's going to be that you need a medium of exchange that doesn't change price between yesterday and tomorrow. That's the whole idea of why, when there are high inflation scenarios in some countries, I won't name who, people flock out of their fiat currency. Even if it's backed by a government, they are still going outside and exchanging it fast, exchanging it for other currencies. And the same thing can be thought about on the Web3 space. As people flock out of centralized stable coins because they think there is an inherent risk on them, then we, Gravita, Liquidity, even GRAI, have a duty, a possibility to provide a medium of exchange that people will actually use, and it's not censorable.
I think Netrim might have cut out for a second. Or is that just for me?
Yeah,
No. I'm done. Sorry.
Oh, yeah, those are great thoughts. Can I just build on that really quickly, by the way?
Please.
So with Liquidity, so there's two really big benefits to a system like Liquidity that's more censorship resistant and more kind of like, just doesn't have exposure to things like USDC. Part is censorship resistance is really valuable to lots of people, but secondly, it just has a really different risk profile. So when the banking scare of USDC happened, and USDC depegged, like what was it, almost 20 cents, it pulled down a lot of the others. And Liquidity was able to defend peg much more quickly than their counterparts. Part of that's because of their hard pegging mechanism that's really effective, but part of it is, well, they don't have direct exposure to USDC, right? So DAI, and you know, in some ways it didn't hurt DAI so much. If you do trust that USDC is really gonna like bounce back, it's not the biggest deal. But DAI, basically, if USDC ever falls, DAI is gonna fall with it. And then if USDC took a big write down, that's gonna be a write down for DAI. So if you're a person who's like, hey, I want exposure to, you know, a dollar peg stablecoin, but I want something that has less exposure to the traditional banking system, you really need to be in something more like LUSD instead of DAI, right? Or if you're like, hey, look, I think the risks there are maybe overblown, but I want to diversify my risks, then maybe you have some DAI and you have some LUSD. You just have very different risk profiles. So that's a pretty important one, is that these more decentralized, censorship-resistant stables, they just don't have exposure to the same TradFi risks.
God, it's super interesting. So I obviously trying to empower liquid staking tokens and having sort of extending the reach of difficult to censor or uncensorable stablecoins. I think we would jump behind those missions. Speaking for everyone at DeFi Insider. So just curious, what's been the greatest challenges that you've encountered in building Gravita?
Right. Can you hear me?
Yeah, I think you cut out, but I can hear you now.
Good. So CDP platforms are kind of interesting. The way that I think about them is, in a lot of ways, it's the most capital-intensive primitive in DeFi to get escape velocity for, and I'll kind of elaborate on that. But on the positive side is once you do get escape velocity, it can be a lot more defensible. You get a lot of network effects and things like that. So in these systems, if you're borrowing via minting, like you do in MakerDAO, Liquidity, etc., Gravita, the people who want to borrow and then, say, take leverage, they need someone to facilitate that swap for them on decentralized exchanges. And so you need to be able to source a lot of people willing to come and provide liquidity in order to facilitate the borrowers. That is just an ever-present challenge for all of these systems as they grow, is drawing in the liquidity to facilitate the borrowers. And what we found, we've only been live for about a month, and TVL hit about 20 million. It's pulled back a little bit because the market dumped the last couple of days. But we have these mint caps in place, for one, as an additional safety measure, but two, we want to kind of grow the system in a sustainable way. And part of like what will inform those mint caps as they rise is how much liquidity we can source. That is our biggest challenge. It'll remain our biggest challenge probably for at least a year or so. All of our protocol revenues, when we do have a Gov token, all emissions will be going, the overwhelming majority of both will be going to solve the liquidity problem. So, on that note, we just got a bunny gauge approved. We're going to do some incentivizing there. We have a curve gauge that's in governance right now. We're working on some other things, but that's a big challenge, and it will remain a really big challenge. So, you don't get to MakerDAO size unless you have a huge number of people willing to come provide liquidity on, in their case, in DAI paired against, either USDC or ETH or other assets. And then in our case, we need people to come provide liquidity for GRAI. So we're trying to make that really attractive, but it's a challenge, and it's something that it's just, to grow to a very large size, you just need a lot of liquidity to come in. So anyway, that's our biggest challenge by far, and it probably will be for the next couple of years at least.
And besides like doing gauges and so on, do you have like any sort of like differentiators between, let's say, Gravita and Maker, for example, where it might be more attractive for certain liquidity providers to come to Gravita?
Yeah, so there's a few things. So one, we will obviously incentivize liquidity, and we're going to do some interesting things on liquidity incentives once the token goes live. As some people here know, we're fans of chicken bonds. We actually have been really, we accepted BLUSD, which is the chicken bond related, yield-bearing stable as collateral in Gravita, and have kind of benefited their system by doing so. So there's some stuff there that we'll be announcing more details on later, as far as what we think is like a really good kind of sustainable way to grow liquidity in a way that's really co-beneficial to the protocol and the users. So it'd be kind of a modified chicken bond that we're looking at. We'll incentivize liquidity. The big thing, the other big thing is there are some, you know, cases for holding a token like this in, you know, in a treasury as opposed to some of the others like DAI, et cetera. So if you're someone who wants to diversify your holdings, say you're just a stablecoin holder, or maybe you want to diversify the stablecoins you're earning yield on, your liquidity provider, you know, you don't have a lot of good options for the more censorship resistant stables. And so you'll notice that some of these big treasuries, they'll hold a mix of DAI, LUSD, maybe USDC, etc. But that's one of the things that we're trying to like appeal on long term is, hey, for those who want to diversify into more censorship resistant stables, we're one of the few options. So yeah, you have some LUSD, that's great. Maybe add some GRAI as well. So that's, you know, we feel like a pretty important differentiator long term. But those are conversations they'll probably, you know, people don't start, you know, throwing your token on their balance sheet in the first month of your existence. But that's, you know, I think there's a case for that as we grow. And then stability measures, you know, there's kind of soft stability measures that all of these systems have, and incentive, you know, liquidity incentives are one of them, and just the way that accounting works in these systems is another one. But the hard, what Liquidity calls their hard pegging mechanisms, work really well. We have those as well. We have not turned them on yet, but that's another thing that will, you know, increase stability of GRAI, and that will make it another, you know, compelling reason to hold it. So you say, okay, I want something that's more censorship resistant. I want something that, you know, is able to, you know, dampen volatility really effectively, and you know, those things we think long term will be like really strong reasons to hold GRAI. But yeah, short term, it's like most people are like, well, we need the system to prove itself, you know, prove stability, prove some growth, you know, prove that, you know, a number of things about the platform. But yeah, I think that will probably be the stronger case long term than like incentives. And getting people to accrue that onto their balance sheet, getting people to hold that as opposed to USDC, et cetera, is super important for the long term.
Yeah, so shifting gears a little bit, so I work for More Money Finance, which is a decentralized stablecoin on Avalanche. I often sort of like sit around thinking about, you know, the different types of stablecoins. So obviously you have the dollar-backed stablecoin like USDC, and then you have the purely algorithmic stablecoins like Luna is always a good example, yeah, you have, you know, LUSD and Maker Maker now more of a wrapper for a dollar-backed stablecoin, but used to be the prime example of a decentralized stablecoin. And you know, sort of like the problem that you come up against is that if you look at all the crypto that is in existence, even if all of it was, you know, staked to borrow, and therefore creating the third type of stablecoin, we still wouldn't have enough money to use in the ecosystem. So you may or may not have a view about this. It's sort of almost a philosophical question because you can't really test it, I think, right now, or maybe you can. So maybe you have an opinion on that. But do you sort of like, and you know, either Red or Netron, like, do you have a view on maybe the future of how this plays out in terms of how do we get enough, or are we at some point going to get enough liquidity on chain to have enough decentralized stablecoins, or do we even need that? Can we just have, you know, mostly dollar backed, but then we have like sort of this decentralized, censorship resistant, you know, stablecoin out there, and maybe it's only 20% of the market, but that's maybe all we need to really sort of, you know, stay afloat. Most people perhaps don't need to have a decentralized stablecoin, and that would be okay for them. Yeah, so excuse the philosophical aspect of this question, but just curious if you have an opinion on that.
I actually like the question a lot. So I do have some thoughts. I'd be interested in yours as well. Yeah, so a few things. I think, for one, this is a common viewpoint, the viewpoint that you have, that like, hey, we need way more stables than collateral backing can facilitate, because the market cap of ETH, Bitcoin, AVAX, et cetera, is just not big enough to facilitate enough stables. So one of my kind of just question marks is, how many stables do you really need relative to the other assets? And so I kind of sometimes think maybe it's a healthy thing to have it grow along with the market cap of crypto. And then if crypto does what a lot of us hope that it'll do, as the market cap of all those assets grow, as you get global adoption, then kind of stablecoin, collateralized stablecoins can grow along with it in like a really kind of steady way. So my first kind of thought is, maybe that's a good thing, for the growth of stables to be somewhat gated by the growth of collateral. And then two other quick thoughts. So one is, I do think there are other ways that you can get more capital efficient if you want to. And I think so. Frax is mostly a wrapper for USDC, but I think what they have shown is that you can have an algo component to something that is collateral backed, and it can work really well. So they have these AMOs where they can mint unbacked Frax and deposit them in certain places. If that's done in a really responsible way, it is a way that you can kind of grow the supply of something faster than the collateral can grow with it. There are risks with that for sure. So if you have an AMO and you mint some unbacked token into, say, a lending protocol that gets exploited, you might end up with a bad debt. So there's definitely risks there. But that's something that I think can potentially work pretty well. And I think to the extent that your network effects and just like demand for your stable grow, I think you could expand the size of an AMO, if that makes sense. And so I actually think in some ways that's what the US dollar did. The US dollar used to be gold backed, and then the dollar started getting a lot of global demand, lots of sources of that demand. There's the petrodollar. The US is the biggest economy in the world, and you have to pay taxes in dollars. Foreign dollar denominated debt all created all this demand for dollars, and then they're able to remove the collateral backing, and it's the demand that has driven the value of the dollar. And so you could see something similar there, where you could say MakerDAO, if their network effects continue to extend, they could implement an algo element, and that element could grow over time. So I think that's a possibility, which could be interesting. And then my one other thought, this is kind of, maybe tangential slightly, but I actually think that, some of these stables, like I said, a lot of people in crypto don't necessarily want to be holding stables. Some do, but having it grow alongside. But a lot of these stables that function the best, the stablecoin itself is kind of a means to an end, where in MakerDAO, what people really have demand for is borrowing. And then the stable, DAI just ends up being like a really good way to facilitate that. And then, just like I really think these stablecoin, a certain amount of stables, it goes along the side with the volatile assets, and it's mostly a side effect. It's a means to an end. Maybe I'm off on that, but that's kind of my view. What do you think?
I mean, I really appreciate your thinking on the sort of the algo hybrid possibilities for the future. I think that's very interesting. I haven't spent that much time thinking about that. I've been spending a bit more time like thinking about, the demand for these tools in the first place. And I guess where I sort of sit with that is thinking, well, I mean, initially when I came to crypto, I was sort of like naively, my first thought was like, oh, we should like replace the US dollar with, AVAX or Ethereum or something that has like underlying value, right? I mean, that would be the best sort of money. Let's agree on what it's worth, and then let's trade in that. But I think maybe in the far future that could be where we end up. But I sort of think in like the medium to even sort of like long, like for the next decade or couple of decades. I think if you live, for example, in Canada, like you don't want to be getting paid and trading and having your wealth in euros, because if you don't want to be gambling. The point of having cash is that it stays stable. which has been a problem over the past centuries because governments always have this temptation to print money. But outside of that, the idea of having short-term reserves in something like a stablecoin is for it to stay stable. I don't see most people sort of like wanting to live in, let's say the U.S. where they're earning and their mortgage is denominated in U.S. dollars and they're holding ETH, even if ETH is like relatively super stable. It will, even if it sort of like deviates from USD by 2% every year, I think that's going to be a problem. And even if it goes, to the upside mostly, but then once in a while it goes to the downside, I think a lot of people are going to be very reticent to hold that. So I think stable coins are going to be a big part of crypto for a long time. So that's sort of where my thinking is right now. And I've, more recently started to think about the topics that you're discussing. So thanks for sharing those stuff. I think it's really interesting.
Yeah, I think there's some truth to that. And to your point about people in different jurisdictions, there's definitely room for stable coins that track things other than just the dollar, right? There's a few of those, but not very many. I think there's room for that. Room for more of that. I think there's also room for experimentation with kind of semi-stable or free-floating stables. There's definitely challenges, but there's some interesting things there where you say, hey, maybe I do want my holdings to be in something that's more stable than ETH or Bitcoin or AVAX or whatever, because my mortgage is in dollars or Canadian dollars. But I'm okay with it not perfectly tracking it. And so, like a free-floating, semi-stable might serve that purpose really well. So that's an area of research in crypto that is still like really new. We have Reflexer, but that's been kind of the main experiment so far. I'll be interested to see some things that happen there. There are some really big challenges with doing it as part of a CDP system, but there's some really good, interesting upside as well, potentially.
So I know that Jared had a question about liquidity, and before he introduces that, I was just curious if you could tell us a little bit about like building with liquidity. I'm pretty well aware of why you chose liquidity. Maybe you can mention a few things on that. But I guess more curious, like how's the collaboration? How has that been? The pros and the cons of building with someone else.
Great question. So I've been a Liquidity Giga fan for a long time. I think in a lot of ways it's one of the best built DeFi protocols ever, I think. Starting there was a really good thing. They're not officially partnered with us or anything. I approached them initially and said, hey, this is what I think needs to be built. Do you want to build it? They said no. And I said, okay, well, I'm going to build it. But because we're forking you, we're going to be friendly to you in like a number of dimensions, and but without like asking anything in return. And but they have given they've been just very kind in return. So like they're not officially partners, and they don't hold any of the future tokens of our Gov token or anything. So it's not an official partnership, but they've been super friendly, super helpful. They've given us really good feedback. And then we're obviously trying to be as beneficial to them as possible. And so it's very kind of like an unofficial thing. It's more of like, I just kind of feel like if I'm going to fork you, I feel like you should benefit from it. It is the real thing. And then they've just been very appreciative to that. And like I said, have been very kind and helpful. On why liquidity, I think, like I said, I think their mechanisms are really, really strong. And their code base, they've never been exploited. They've been around a while. They've been battle tested. They've gone through some really volatile times, and LUSD and the liquidation system, et cetera, have functioned really well. So it's super battle tested. So that's a really good thing. We love the mechanisms. Like we think that, for instance, the stability pool for liquidations is a really good way to go. And for a couple of reasons. For one, it can liquidate borrowers really quickly, as opposed to, let's say, like an auction-based system. So that allows you to give better borrowing terms. But also, it kind of democratizes participation in the liquidations. And, so normally, it's really only bots that participate in liquidations. Average users aren't able to, but with a stability pool, they're able to. And it has really interesting dynamics. So if you're using it just to DCA from, stable coins into ETH, each time there's a liquidation, you're DCAing at a discount. So that's great. Or if you're using it to just generate yield, so every time there's a liquidation, you just sell that right back into GRAI, it becomes a really interesting, counter-cyclical yield source. So as a quick example, during the 3AC blow up, the yield on the liquidity stability pool went from it was 5 to 7% up to 750% for a few weeks. So it's this really interesting thing where you're like, hey, I want a yield source that generates outsized yield whenever the market's in the worst condition. It's a really interesting kind of play there. So yeah, we love their mechanisms. Super battle tested. Love the team. They're some of the best innovators in the space. So yeah, unofficial relationship, but we love them, and we hope to basically, as we grow, we hope for that to benefit them in a really big way.
Cool. I think obviously Liquidity has a pretty, as you said, battle tested, very high quality kind of product in their model. I wanted to get into some of the kind of core mechanics of Gravita. Just to start off, can you kind of just explain and also maybe just give a bit of a rundown on some of the following topics, just for anybody who might not know or be familiar with Liquidity or with Gravita. Can you talk about the stability pool? I'm kind of curious, just how is the Gravita stability pool kind of either similar or different from the one on Liquidity, and maybe just a little bit about how it works.
Yes, yeah. So I'll give you, let me just overview the system, and then I'll drill into the stability pool a little bit. So the way that borrowing in the system works, I call it sometimes protocol-to-peer lending, as opposed to peer-to-peer on Aave. So a user comes in, takes one of our accepted collateral types, say ETH. They deposit that as collateral, and then they mint GRAI as their borrow. They pay a one-time borrow fee with no ongoing interest rate. And in our case, that one-time borrow fee, you get a pro rata refund if you repay in under 6 months. The TLDR on that is we want it to be a really good borrowing platform for both long and short-term borrowers. So that's how you borrow. That's how GRAI is created. Now, the stability pool, the way that works is anyone who holds GRAI, whether you minted it or you go swapped for it on Uniswap or whatever, you can deposit it into this pool. And when a borrower in the system becomes over leveraged, they hit their liquidation threshold, a liquidation is triggered and their debt is pro rata burned out of the stability pool. Well, it's just burned out of the stability pool. And then the stability pool participants pro rata capture that collateral. And since someone gets liquidated on ETH at a 90% loan to value and on RETH and STETH at an 85% loan to value, you basically, at that moment, you're converting GRAI into ETH at a 10% discount or into STETH or RETH at a 15% discount. So, if I'm 50% of the pool, I deposit 100,000 GRAI and I'm 50% of the pool, and somebody gets liquidated on a $100,000 position, then 50,000 GRAI of mine gets burned to cover their debt. I cover half their debt, so half of the pool. And then I capture half of their collateral for the liquidation. So all liquidations are complete. There are no partial liquidations. All of your debt gets burned. All of your collateral gets distributed amongst the stability pool participants. And then the one key difference between our stability pool and Liquidity's is that Liquidity's a single collateral platform. So you're always burning LUSD to capture ETH every time. And in our case, you're burning GRAI to capture ETH, technically wrapped ETH, or RETH or STETH, or other collateral assets that we will add to the platform later. And so you may end up, say you deposit a bunch of GRAI into the stability pool and you forget about it for a year and you come back, you'll have some claimable you'd probably have some claimable assets of multiple different kinds. You'd have some claimable STE, some claimable RE, some claimable ETH, etc. So that's the main difference between our stability pool and theirs. It's just collateral, multi-collateral versus single.
Hey, just curious, how much is of the overall protocol is like an exact fork of Liquidity versus like how many small modifications have you made? And also curious on that question, like how you went about doing those modifications, if you did any. Like, do you have a dev team, or are you reviewing this yourself because you have a background in tech? Yeah, just curious, like on the implementation side.
Yeah, great questions. So, quick background on me. I know how to code, but I've never written a smart contract. I've more machine learning models is what I've done a lot of. And Fornax, who's in the space right now, is the lead on smart contracts. We have 3 team members writing smart contracts, and then one that's kind of focused on our front end. That's the tech side team. I wrote none of this. Fornax wrote a lot of it. A guy named Spider and a guy named Geo. The 3 of them were the ones writing the code. So 0 of that can be attributed to me. I merged no code into our GitHub repo. So the number of changes that we made. So it kind of depends on what you mean by like how substantial. So Liquidity was written a little while ago, and libraries and things like that have updated since then. And then there's obviously like renaming of things, from LUSD to GRAI, et cetera. So there's a lot of superficial changes. So a lot of the code base got touched. And then foundational changes that were like kind of actually like real substantial changes from Liquidity to Gravita are a few fold. Our stability pool works pretty differently. It's a substantial change to go from a single collateral to multi-collateral. And there's different ways you can do it. So Vesta is also a fork of Liquidity, but they have a stability pool per collateral type. So, they have a stability pool for ETH, one for Bitcoin, one for GLP. Ours is one stability pool for all. So that was a substantial change. The fee model change was pretty substantial as well. So in Liquidity, you pay an upfront mint fee. It's variable, but it tends to be 0.5%. But if there's been a lot of recent borrowing, it will move up along a curve to a max of, I think, 5%. Ours is fixed instead of variable. So it's 0.5% no matter what. And then theirs you pay up front. So you pay the full 0.5% no matter what. And in our case, you pay that up front, but then we have this kind of rebate mechanism if you close early. So basically, it's a 6-month window, which means that essentially you're paying a 1% APR if you borrow for less than 6 months. If you borrow for more, then it's that one-time 0.5%, no interest ongoing after that. So that fee model change was pretty substantial as well. And then we are building additional things on top. So Liquidity is immutable. We are not. We really value the immutability, but we felt like there's a lot of things that we need to kind of build and ship first. And so we will look to harden the protocol over time. But, right now, for instance, we're looking to deploy onto the L2s. We're looking to onboard new collateral types. We're looking to build some other things on top. So we're not immutable. Yeah, those are the two, in V1, the two really substantial changes, other than kind of superficial changes, like I said, are the stability pool implementation and then the fee model change.
Hey, just a quick follow-up. You said that there were 3 different dev collaborators. Just curious why you're working with 3 different people versus like a single sort of like high-level dev. Is it just like availability, or do they have different specializations? And also, how did you raise capital to reward them? Are they just getting tokens from the team allocation, or how does that work?
Great question. So the reason why we have multiple devs is just because we want to be able to, just time to ship and the amount of effort to make those changes, and then also to implement the additional things we're building now. It's just, we just felt like that was a better team size than a single dev. It allow us, like I said, to move through our roadmap in a reasonable time frame. So that's the reason why there's more than one. And they have kind of different specialties a little bit. So we have one guy kind of focused on front end. We have a couple really focused on the smart contracts. And then there's one that he writes smart contracts, but he also does a lot of the kind of connecting between the two, like, really good at, the connections between the front end and the smart contracts is like, he spent a lot of time on that. So that's kind of why the team's the size that it is. And then on funding, so we did a small angel raise thus far, raised less than $1 million. 1KX is a really awesome VC. For those who don't know them, we love them. They basically approached us and basically said, we like what you guys are building. We'd like to write you a small check and help you raise some more. And we took them up on the offer. So there's a couple of VCs and a handful of angels that wrote checks. And it's not a lot of runway for us, but that enabled us to pay for audits and then also, pay the devs. So that's what we've done so far. Probably, the majority has probably gone to paying for audits, and then, and then the rest has been going to pay for devs at the moment. And then devs are also, there's some allocation of like the future token supply that's going to team members as well. So it's both.
Nicely done.
Yeah, pretty cool. Can we? I'm kind of curious about your decision to go with zero interest as like a sort of zero loan fees. I know you have like that upfront 0.5% fee, but I personally really love the idea of zero interest loans. I think it kind of makes the choice to go with this kind of platform versus another one kind of like a lot easier, especially for people who want to have like very long-term loans and they don't want to be worried about interest eating up their collateral over time. But can you talk about some of the reasons why you chose to go that way, and maybe also some of the, if it presents any kind of challenges?
Yeah. I have lots of thoughts on this. So what we've seen with liquidity of that one-time fee is that while it's really good for borrowers, like really attractive terms, and does not generate a lot of protocol revenue kind of per dollar borrowed. If you hit enough scale, it still can generate pretty good revenue. So liquidity is been around a couple of years, and I think it's generated like something in the range of $25 million of protocol revenue over the last few years. So if you hit enough scale, it can still be substantial, but it is really, really nice for borrowers. And since we do the pro rata rebate, we kind of feel like it's really good terms for short-term borrowers and for long-term borrowers. And you kind of, from the business perspective of generating protocol revenues, it's more of a game of hitting high scale. But there are some downsides. So, actually, sorry. Let me give one more upside, and then I'll talk about some of the trade-offs and some things that we've kind of thought about. So, one of the other upsides, which is kind of an interesting aside, is that there are a lot of people in the world, specifically a lot of the Muslim population of the world, that basically don't participate in a lot of kind of traditional financial instruments because they're not allowed to engage in like interest-bearing borrowing and lending. A system like ours, there's reason to believe there's like a good case for it being more Sharia compliant. So that's like an interesting, nice aside. One of our users actually approached us recently. He's like, hey, I'm Muslim, and normally I'm not able to participate in these systems, but because it's just a one-time loan origination fee and no interest rate, and he's like, I actually can participate in this system where I couldn't participate in others like Aave. So there's a really interesting thing there. That's kind of like, a small aside, but we want this to be interesting and accessible to the whole world. One of the ways that I think about liquidity and the zero interest lending approach is there's a trade-off, there's a pro and a con. And if you're familiar with the redemption system of Liquidity, it basically is a way for them to keep LUSD hard pegged. And the very, long and short of it is that if LUSD ever falls below $1, people can pick up LUSD at a discount, and then they can go redeem one LUSD for $1 worth of collateral from the riskiest borrower in their system. And because it's one-to-one with no penalty, you're really just reducing that borrower's ETH exposure. If that riskiest borrower had borrowed 500K against $1 million and you redeemed 100K, well, now they'd have a 400K loan against 900K. So their net value is the same. They reduce their ETH exposure. It's still, users don't like to be redeemed against like that. But in some ways, I would say redemptions are the cost to zero interest. So there's a trade-off there. And what we have thought about, and this, this is something we may implement in the future, is, you could give the optionality where you say, look, get a one-time borrow fee, 0% forever, but you can be redeemed against if GRAI is falling below $1. Or alternatively, you could pay a peg-informed interest rate. Say if GRAI's at $1, you're paying 0, and if it falls to 99 cents, you're paying 1% until it restores. But you're no longer in the redemption queue. And then different borrowers would have kind of the appeal of the different groups, or of the different systems. Like different borrowers would be attracted to different terms. And both of those types of borrowing system, both of those types of terms help stabilize GRAI. So there definitely is a trade-off there. There's a pro and a con. Like I said, we've thought about giving optionality so people can kind of choose which set of trade-offs they want to accept. But it's definitely not costless. It's low revenue to the system. And then you do need, since you're not using interest rates in order to help stabilize your debt token, you need to have this other system instead.
Nice. You talked a bit about the GRAI token here and there. I just wanted to see if there's anything else you kind of haven't mentioned about it yet. I'm just curious about like the tokenomics, and the reasons for the just maybe different decisions you made with the different fees and redemptions and stuff that go along with the GRAI token.
Yeah, good question. So GRAI, it's our debt token. It functions a lot like LUSD. A lot of the same functionality. One thing to note right now is that that redemption piece, that hard pegging piece, we have not turned it on yet. What we found is that can really help you hold peg in a really good way. But if you lean on it too heavily, it can also be pretty punitive to borrowers. So what we're doing is we're activating it later after we have done a lot on what we'd call like the soft peg side, like incentivizing liquidity and those sorts of things. And then we also, when we do implement it, initially it will be implemented with kind of like a little bit of a discount, so it would activate a little bit lower. We think that it's okay to flex, around the dollar a little bit more, whereas with LUSD you see that it basically flexes between like $1, $1.02. If you're kind of flexing more around like, 99 cents to $1.01 or whatever, we think that's like more acceptable. So the redemption functionality is really good. It's like a really hard floor, but you don't want it to be activated too soon. Or too often. So we'll activate it later. And then initially when it's activated, instead of redeeming one GRAI for $1 worth of collateral, it would be 1 to 97 cents worth of collateral. And then when necessary, we may inch that up closer to a 1-to-1. But the idea is to have that as a lever when you absolutely have to use it, but hopefully it's a lever that doesn't get pulled very often. And we see from some of these systems like DAI and Abracadabra and some others that don't have hard pegging mechanisms at all are still able to stabilize pretty well just with the soft mechanisms. So that's one of our things is, okay, let's get as much out of the soft mechanisms as we can, and then have that lever there for when it's absolutely needed. So yeah, you'll notice obviously no redemptions have occurred because that feature is it's deployed but not activated currently.
Okay. I would also ask Netrim, just curious about your perspective on the token and tokenomics and how you see this the GRAI token.
Yeah, basically, I mean, it's like Red was saying. So, GRAI will grow as people use it, and obviously, this is something that I want to go back to the, let's say, to the early stages of this space. The idea is that these stables, the CDPs, the collateralized, they grow as big as the collateral. And Gravita here has a great opportunity, has a great market fit for that, because the LST space, the liquid staking tokens we are seeing all around through Ethereum, they are going to get bigger. Lido is not going to dominate. So as new types are onboarded, we will provide a common service there that they can leverage their own LSTs and keep earning on their collateral, but also provide a safe avenue for what to do with GRAI. GRAI becomes a stable that people not only want to swap and not have, but as Red was saying at the beginning, start approaching and for protocols to start thinking, okay, what do I have on my treasury? What do I have on my balance sheet? Am I censorable in any way because of the assets I have? And this is purely a philosophical discussion that protocols will need to have within them, and DAOs will have within them, and we shall see how it goes. Clearly, the space is, let's say, underrepresented at the moment, and it will keep growing as the crypto space keeps growing.
Well said. Yeah, I think I agree. I mean the tokens will see more usage. It's pretty clear that like you kind of have a good niche here. You have a good place for people to put their tokens that may not have any other use, or maybe this is just kind of the best use of their tokens if they want to kind of increase, like leverage on top of it. So, yeah. One of the things I kind of wanted to know about was I noticed in your docs and I think on your webpage, you mentioned that you have plans to make Gravita eventually become immutable. Can you kind of break this down a little bit? The reason why I'm asking is just because I look at Liquidity and I do think that while they have a very strong sort of base of things that they built, I you may disagree with this, but I kind of, from a personal opinion, feel like one of the weaknesses of Liquidity is that because they're immutable, they can't expand their offering. They can't make any modifications if they ever wanted to. And if there was ever some kind of big change in the market, they wouldn't necessarily be able to sort of adapt to that. Do you think that this is like a valid concern, or you're not really worried about it?
Yeah, so a couple of thoughts here. So it's a major trade-off is what I think of it with Liquidity, is they are by far the most censorship resistant stable and CDP platform, and immutability is part of that. But they give up a lot. They give up scalability, they give up enhanceability, etc. And I think that's a fair trade-off for them to make to serve that really key niche. But I also think it's fair for others to not have that trade-off. I think there's a good reason why very few CDP platforms are immutable. We really value censorship resistance. We value immutability, etc. We may or may not be able to ever get to full immutability. For instance, like onboarding new collateral types is something that will probably always require governance, etc. but we do value the benefits that come from immutability, and so our goal is to harden over time as much as we can. If eventually we can get to full immutability, there are some really great things about that. I don't think we ever said we necessarily are committed to full immutability in the future, but we value immutability and want to be able to harden when we can. And if we can get all the way there, that would be great. But I wouldn't expect that in the short or even medium term. But yes, it's a trade-off thing, and how big the trade-offs are may shift for us over time. Where if we get fully through our roadmap, where we have like all of what we think are the key features, maybe the collateral space has really like matured over the next few years, where it's like, okay, we kind of know which LSTs will be there, and then ETH, and we maybe don't need to onboard new collateral types going forward, just depending on how things kind of emerge in that sense. Then yeah, you may be able to just go full immutable at that point. Or what's more likely is what I would call like hardened / like governance minimized. So you say, okay, maybe you can harden 80% of the code base, and you just maintain this like small piece that has some modifiability and a governance structure built around it. That might end up being like the right balance for us. Yeah, there's some really great things about immutability. It's like for Liquidity, it is a superpower where anyone who has reviewed their code base and their system, like their system's not going to change, 5 years down the road. It can't ever change, and so there's some certainty, some safety, some censorship resistance that comes from that, and I think it's just a great thing to value and to kind of like strive toward. But to your point, it comes with major trade-offs, and we kind of didn't feel like at day one we could accept the trade-offs of deploying as an immutable code base from day one, for instance. And some of our users who are big Liquidity fans came in and were like, well, I see you're not immutable. Why not? And we're like, well, here's why. We just didn't feel like we could like serve our purpose properly and be immutable right now. And people have been really nice about it. And they're like, yeah, it makes sense. It's like, it's reasonable, So I don't know if that answers the question very well.
Yeah, I think so. I kind of like the answer. So basically, kind of like at some point, you may consider a bit of like a hybrid situation where, like you said, you can harden some of it, but then you're also a little bit open to, if you ever really needed to want to, maybe want to add new assets or something, or if you need to change some kind of like something about it. Yeah. So I'm just gonna want to move on to the kind of last section of this chat. I was just curious if you had any sort of maybe a bit of like alpha or something. I don't know, some example strategies for anybody who might be listening on how they might best use the platform and maybe get a good return from it.
Yeah, would love to share a few. I think most people know that these systems can be used for the degens who want to lever up. That's like an obvious one. Throw your RETH, your SDETH in there, borrow against it, buy more, and loop that up. So for those who want to do that, totally fine. Those ones are pretty obvious. I think for those who do want to leverage, I think sometimes it's underappreciated, the approach of like taking very light leverage. If you say, look, I think we're at a low point in the market. I think that ETH will be a lot higher in 5 years. Maybe instead of doing like 2x levered with your LST, maybe you do like 1.1x or something, like kind of low leverage that you hang on to for longer. I think that's kind of an interesting strategy for the leveragers. Something that you think is like kind of below what I call the risk of ruin threshold, that you can just sit on for longer. So that one's interesting. But the ones that I'm really interested in are these kind of like kind of more cautious plays. So there's a few of them. For one, people who want to just dollar cost average from stables into ETH and LSTs. It's simply go swap your USDC for GRAI on Uniswap and throw it in the stability pool and forget about it. That, it's kind of interesting in the sense that liquidations happen more when the market's nuking, and so you're going to be buying the dip, and you'll be buying the dip at a discount, and converting your stables into ETH at kind of like a good time. So that's an interesting one. And then the other one that I think is like an interesting way to use these systems, and it's a way that I tend to use the systems more, is say you're a person who has a bunch of ETH or an LST and you have stablecoins. Well, what you can do is you can come in and say, look, I'm just going to mint like a really low loan to value. I'm going to take $100,000 of my LST. I'm going to mint 10K. I'm going to match that up to 10K of USDC and just throw it into the Uniswap or the Bunny pool or the Curve pool. And now you're just earning an additional layer of yield. You left all your stables in stables. And so, if the market ever nukes, you can just kind of pull back and pay down. And so it just becomes like a basic yield play of like, oh, I'm just able to use those assets a little bit more efficiently, and I'm layering a little bit of yield onto the yield I'm already getting in my LST. And then a similar one to that, like say you just hold the LST and you don't hold any stables, you can do something similar where you just say, oh, I'm just going to mint like a really low loan to value and just throw it in the stability pool. And then, when liquidations occur, you can either claim and sell back into GRAI, and then you're just generating yield that way, or it's a way to like slowly build a slightly levered position at like attractive, like discounted terms. So those are some ways that like I like to use these systems. I have done the degen thing before and levered up hard in some of these systems. I've also been liquidated before. I don't tend to do that sort of stuff a lot anymore. It's more like, mint a small amount and go liquidity provide or go throw it in the stability pool. But we really hope to be an attractive place for both types of user. Like if you're a degen and you want to go max leverage, our goal is to be kind of the best terms place for you to do that. And then if you're kind of a safer user, we can use some of these other approaches.
Yeah, building on what Rez is saying, the idea is to have GRAI as a composable asset. So right now we are building liquidity. We are trying to deepen that liquidity on some fronts like Bunny or Maverick. And remember that that's a baseline play. As Rez is saying, then you can lever up if that's your choice. And there's nothing wrong with that. And by levering up, you can, increase your exposure, for instance, to ETH or the LSTs. And that's perfectly valid. But as we grow the ecosystem, as we grow these options for GRAI, new opportunities will arise as we bring composability to the GRAI. So not only have it, not only LP on it, but maybe use it as a collateral somewhere. We will need to see how it plays out and what type of strategy is the best around the corner. This is a very evolving market, and we shall see how it grows. But our main focus right now is liquidity. Liquidity depth, it becomes a really necessary item for us to actually empower and grow the GRAI ecosystem.
Yes, on that note, by the way, a little bit of additional alpha. Netrum mentioned a couple of places. So you'll see GRAI pools on, right now, you'll see them on Curve, Uniswap, Bunny, which is on top of Uniswap, and then also Maverick. We're starting to do a lot more with those. So for someone who wants to just come in and generate yield, etc., our Bunny gauge went live today. We'll start incentivizing that very shortly, and it's a liquidity pair between GRAI and USDC. So that's one to look at. We already have a pair with GRAI and LUSD for people who want to be in two more censorship-resistant stables. That pairs on Maverick, so that's an interesting one. And then one of the things that we're going to start doing more soon is some with GRAI and some of our collateral LSTs. That can be an interesting one for a very certain type of user. So if someone provides liquidity between ETH and LUSD, for instance, it's basically what that position becomes is essentially volatility dampened ETH with some baked in yield. In our case, if you're providing liquidity between an LST and GRAI and you're getting incentives, again, it's basically a volatility dampened ETH position with multiple layers of yield. So you get trade fees, the LST has baked in yield itself, and then there'll be incentives as well. So for someone who's like, hey, I want ETH exposure, but I don't know if the SEC is going to nuke the market. I want my volatility dampened a little bit. That's kind of an interesting play to be in for that type of user. So that's where a lot of incentives and things are going to be going in the short term and probably the long term as well. But yeah, for those who don't want to lever up but just want to just go generate some yield on some dexes.
Nice. It just made me think of one thing as you were speaking. Are you making use of any kind of sort of concentrated liquidity pairs where maybe you don't need to have quite as much liquidity in order to sort of facilitate at least low fee transactions or low slippage transactions?
Yes.
I'm just wondering because in the past, I would imagine anybody who's trying to make like a stablecoin play, the amount of liquidity that you needed before just to be able to facilitate like basic trading from just to go back and forth, I feel like is way higher than it is with sort of like concentrated liquidity offering.
Yeah, it's a good point, and yes. So a couple of things. So by the way, we also have a curve gauge in governance right now. Any curve holder, any CRV holders would love it if you came voted for us. So that ends up kind of those are kind of somewhat concentrated, and then Uniswap v3 obviously allows for concentrated LP. This bunny gauge that we just got is under the hood. It's a Uniswap v3 pool that is concentrated between 98 cents and $1.01. So that is a concentrated pool. And then secondly, we're actually probably going to rework this one a little bit. But Maverick allows for basically concentrated pools that will kind of move with the price, so that it's less likely to kind of go out of bounds. We kind of experimented with one of those on Maverick with the GRAI LUSD. It was a little bit too narrow. The parameters weren't quite right, so we're gonna modify that one. But yeah, so both Uniswap and Maverick already have concentrated pools. The bunny pool is probably the easiest way to participate in that right now, and then Curve coming soon. And then we are kind of working on layer 2 deployments, both of liquidity, and then afterward we'll deploy the application. But some of the dexes on L2s that we're talking with also facilitate concentrated liquidity, and we'll be doing that as well. So yeah, we may even just like tighten up that concentration over time. So that bunny pool that's at a 98 to $1.01, as the system kind of settles and volatility reduces in GRAI, then you could tighten that up and deploy a gauge later that's maybe like 99 cents to $1.01, like very, very, very tight. So yeah, almost all of our liquidity right now is already concentrated. That's where the focus would be going forward as well, and then we'll have a little bit wider liquidity with things that are paired to like GRAI paired to ETH or RETH to ETH, things like that. So we'll have wide liquidity for those that aren't like kind, but the liquidity to LUSD and USDC and the other things, we have a GRAI. It's a GRAI Frax based pool on Curve. Those are all more concentrated.
All right, cool. I just got one more question for you on my list of questions. and that is when airdrop.
Good question. So we have not, we haven't announced timeline or even confirmed an airdrop just yet. But so high level, we will have a Gov token. It will be live, not in weeks, not in years. So it's, you know, the timeline is kind of months, and it obviously will have governance in our system. We'll need to, you know, have a governance system for onboarding collateral, et cetera. And we want the team to be able to hand off that responsibility to the DAO. But there will be other functionality in that token as well. And then most of the token is currently unallocated, and most of that will go to the community, but it'll mostly be paid out to the community for doing things that, you know, help the system achieve escape velocity. So most of it will end up going toward, you know, liquidity providers, most likely. And we do, you know, you asked about a fundraise earlier. We do probably do another fundraise just because we're thin on runway and have a lot more on our roadmap that we want to get through, but or, you know, a lot of enhancements we want to build. But so we probably do that, but the majority of the token is going to be going to the community through those mechanisms. So short term, we'll incentivize those things with protocol revenues. Medium and long term tokens. So, but yeah, I don't have an exact timeline for you, and whether we do a retroactive airdrop and what the terms of it are, et cetera, is yeah, not something we're ready to announce just yet. But we want to do things in a really community-centric way. We want the token to be broadly owned. We want it to be distributed in a way that's really fair and community-centric, and in a way that increases the likelihood that the system can get, you know, escape velocity and be a really stable, useful utility.
Nice. All right. Well, that's all the questions that I have for you today. I don't know if anybody in the audience wants to you know, raise their hand and ask a question, but I think we're pretty good from here. Thank you for coming on, and Netrim, thanks for coming on too.
I appreciate you having us.
Yeah, Netrim, thanks a lot for coming on. And if anyone's listening, if you appreciated this content, please follow us on Twitter for more to come. And yeah, great. Goodbye, everyone.